You have money sitting in your account right now, and you genuinely do not know what to do with it. Not because you have not looked it up, but because every time you go searching for answers, you find two camps screaming at each other and nobody actually giving you a framework. One side says the market is at record highs, stay invested, do not blink. The other side says inflation is back above 4%, AI is eating jobs, geopolitical risk is everywhere, and cash is just the smarter move right now. Here is what nobody is saying out loud. Both of those positions have real data behind them. This is the wealth metrics. We run the actual numbers, and today we are building both sides of this debate clean, fair, and without the noise. So you can make the decision that fits your actual situation. Because the wrong move right now is making a financial decision based on headlines instead of math. Let us start with the case for continuing to invest, because the data here is stronger than most people currently realize. As of June 2026, the S&P 500 is up over 8% year-to-date and hit a record high of 7,600 earlier this year for the first time ever. The Nasdaq is up over 11%. The Dow is up nearly 7%. These are not small numbers for 6 months. Yes, there was a pullback in early June, about 2.7%. But a correction is technically a 10% drop from a recent high. We did not come close. So the first argument for staying invested is simply this. The trend is still up, and you do not exit a trend that has not broken. But the stronger argument is the long game data, and it is overwhelming. The S&P 500 has delivered an average annual return of roughly 10% per year going back to 1928. That includes the Great Depression, 2 world wars, the dot-com crash, 2008, COVID, every panic investors have ever faced, and the long-term average barely moves. Fidelity puts the S&P's average 30-year return through December 2025 at 10.4% annually. 2024 returned 25%. 2025 returned 17.86%. If you were sitting in cash during either of those years waiting for the right time, you missed compounding that most people never recover. Time in the market almost always beats timing the market. That is not a slogan. It is a documented mathematical reality across nearly a century of data. There is also a corporate earnings story happening right now that the headlines are not amplifying enough. In the first quarter of 2026, S&P 500 earnings per share grew 27.93% on revenue growth of 11.71%. That is not a market running on hype. Those are real profits from real companies. The underlying engine, while uneven, has not stalled. So that is the bull case. Year-to-date gains above 8%, all-time highs earlier this year, a century of 10% average annual returns, and corporate earnings still expanding. Now, the bear case for holding cash is not irrational either. And in a moment, we are going to look at the exact numbers that are causing serious investors to rethink their exposure. But first, if you have been searching for a clear answer to this question for months and keep coming up empty, this channel is built for exactly that. Subscribe to the Wealth Metrics and hit the bell. We run the numbers every week so you do not have to. Here is the uncomfortable reality. This is one of the most genuinely complicated investing environments in recent memory. Start with inflation, because this number changes everything. As of May 2026, annual U.S. inflation came in at 4.2%. That is the highest reading since April 2023, and it was the third consecutive monthly acceleration. Energy costs are up 23.5% year over year. Gasoline is up over 40%. Food is up 3.1%. Shelter costs are still rising. Core PCE, which is what the Federal Reserve watches most closely, is sitting at 3.3%. That is well above the Fed's 2% target. Here is why this matters for investors. If inflation is running at 4.2% and your portfolio is volatile, you are not winning just by being in the market. You have to beat 4.2% after taxes just to break even. And the Fed is not helping right now. As of June 17, 2026, the Federal Reserve held rates steady for the fourth consecutive meeting. Target range, 3.5 to 3.75%. More importantly, the market is no longer expecting rate cuts anytime soon. Some analysts are actually debating whether the next move could be a hike, not a cut. That is a completely different environment from what investors experienced in 2023 and 2024. Now layer on the job market picture. The overall U.S. unemployment rate looks healthy at around 4.3%. But inside that number, the tech sector unemployment rate has climbed to 5.8%, the highest since the dot-com bust of 2002. According to Challenger, Gray and Christmas, 26% of total job cuts in April 2026 were directly attributed to AI. AI is now the third leading cause of layoff plans across all industries in 2026. Among workers aged 22 to 25 in AI-exposed roles, employment has fallen 16% from its late 2022 peak. For young software developers specifically, nearly 20%. When your income feels uncertain, your emergency fund becomes more important, not less. And money sitting in the market is not actually available in an emergency if the market is down when you need it. And then there is the recession question. Prediction markets as of late June 2026 give roughly a 12% chance of a technical recession by year end. Goldman Sachs and RSM place odds in the 25 to 30% range. Some economists citing sustained oil price volatility and geopolitical risk have pushed personal estimates as high as 50%. The range of expert opinion alone tells you something. Even the professionals are genuinely uncertain, and the spread between 12% and 50% is enormous. One research firm described the current consumer as exhausted. Growth is slowing. Inflation is re-accelerating. The stock market and the real economy are not telling the same story right now. That is the full bear case. 4.2% inflation with no rate relief in sight. AI layoffs accelerating in measurable ways. Recession odds that serious institutions refuse to call zero. A consumer showing real strain underneath the surface. A reasonable person could look at all of that and say, this is not the moment to be fully exposed to market risk. Now here is the number. The hold cash camp is often missing because cash is no longer earning zero. As of late June 2026, top high-yield savings accounts are paying up to 5% APY. Most competitive mainstream accounts are sitting between 4 and 4.2%. The national average savings rate, according to the FDIC, is still only 0.38%. So if your cash is sitting in a standard bank account, you are almost certainly leaving money on the table. Quick math. $10,000 in a high-yield savings account at 4% for 1 year earns you $400. At a standard bank's 0.4% rate, you earn $40. That is a $360 difference for doing nothing except picking a different account. No market risk. FDIC insured. CDs are also paying up to 4.4% right now for fixed terms. U.S. Treasury bills are yielding in the 3.5 to 4.5% range, depending on duration. So holding cash in 2026 is not the same as holding cash in 2021 when rates were near zero. There is real, low-risk yield available if you know where to put it. But here is the harder question. Is 4 to 5% enough to justify sitting out of the market? If the S&P delivers 10% this year, cash at 4% costs you 6 percentage points. But if the market corrects 15 or 20%, your 4 or 5% return suddenly looks like the smarter call. That is the core tension. And the answer is not the same for every person watching this. Here is the framework that actually resolves this debate for your specific situation. Question 1. Do you have a fully funded emergency fund that is completely separate from your investments? 3 to 6 months of living expenses in liquid low-risk savings that you would not touch your investment portfolio to access. If that does not exist yet, that is cash you should be building right now. Not because the market is scary, but because a market crash and a personal financial emergency tend to happen at the same time. That overlap is exactly when people are forced to sell at the worst possible moment. If your emergency fund is incomplete, the answer to invest or hold cash is hold cash and build the cushion first. That is not fear, it is sequencing. Question 2. When do you actually need this money? Money you need within 1 to 3 years does not belong in equities. A 20% correction could hit right before you need those funds, and you would have no choice but to sell at a loss. Short-term money belongs in short-term instruments, high-yield savings accounts, CDs, or treasury bills. Money you will not touch for 10, 15, or 20 years has a completely different risk profile. Over any 20-year rolling period in U.S. market history, the S&P 500 has never delivered a negative return. Not once. Short-term volatility looks very different from that lens. Question 3. Can you actually hold through a 30% drawdown without selling? J.P. Morgan research found that the average investor earns about 2.9% annually, while the market earns roughly 10%. That gap is almost entirely explained by one behavior: selling during downturns and buying back in too late. If you know from past experience that you panic sell, a more conservative allocation is not a mistake. It is self-knowledge applied to finance. A slightly lower return you actually hold beats a higher return you exit at the worst moment. Question 4. How stable is your income right now? With AI-driven layoffs accelerating, tech sector unemployment at 5.8%, and 1 in 6 employers expecting to reduce headcount this year, job security looks different than it did 2 years ago. If you are in a sector with elevated AI exposure and your position feels uncertain, your effective risk tolerance just lowered whether you updated your plan or not. Higher cash reserves when your income is at risk is not paranoia. It is adjusted math. Once you have worked through those 4 questions honestly, here are the approaches that have real data behind them in environments like this. Strategy 1. Dollar cost averaging. Instead of trying to decide whether right now is the right time, you invest a fixed amount at fixed intervals regardless of conditions. You automatically buy more shares when prices are low and fewer when prices are high. You stop trying to predict and start just accumulating. For someone anxious about current conditions but committed to long-term investing, this removes the decision from the equation entirely. Strategy 2. The 3-bucket system. Bucket 1 is your emergency fund in a high-yield savings account earning 4 to 5%. This is fully off limits. Bucket 2 is medium-term reserves, money you might need in the next 1 to 3 years, sitting in CDs, treasury bills, or a money market account earning real yield right now. Bucket 3 is your long-term investment portfolio, your 401k, your IRA, your brokerage. Money you will not touch for a decade or more. The 3-bucket system dissolves the invest or hold debate by making it a false choice. You do both. You just assign each dollar to the bucket that matches its timeline. Strategy 3. Check your allocation, not just your position. A lot of people frame this as all in or all cash. The more precise question is whether your current asset allocation still reflects your actual risk tolerance and timeline. Volatility is not a reason to exit the market. It is a reason to verify that your allocation still makes sense for where you actually are in life right now. Strategy 4. Do not sleep on bonds and treasuries as a middle path. The current rate environment means fixed income is yielding something real for the first time in years. U.S. Treasuries at 3.5 to 4.5% with government backing represent a genuine middle ground between full cash and full equity exposure. That middle ground simply did not exist during the near-zero rate era. It exists now, and it is worth understanding. So here is what the wealth metrics is actually going to tell you, and we are going to skip the hedge. If your emergency fund is not fully built, build it first. Park that cash in a high-yield savings account earning 4 to 5% while you do it. If your income is at elevated risk right now, from AI exposure, sector disruption, or genuine job uncertainty, hold more cash than you normally would. That is not fear. That is your actual situation informing your actual plan. If you have a stable income, a fully funded emergency fund, and a 10-year-plus horizon, continuing to invest in a diversified portfolio through this volatility is supported by a century of data. Dollar-cost average your way through the noise. Do not try to time the market based on headlines. The people who exited in March 2020 because of COVID missed one of the fastest recoveries in market history. And do not dismiss the real risks either. 4.2% inflation with an uncertain Fed and accelerating AI disruption is not a normal environment. It deserves a thoughtful response, not a shrug. The investors who build wealth long-term are not the ones who predict the market correctly. They are the ones who stay aligned between their investments and their actual life circumstances. Review your emergency fund. Check your timeline. Honestly assess your income stability. Then act based on that, not based on what someone on the internet says the market will do in the next 6 months. That is the framework. That is the math. That is the wealth metrics. Now we want to hear from you. Are you investing through this, holding cash, or doing some version of both? Drop your actual position in the comments and tell us why. This is exactly the kind of debate the comment section exists for. If this breakdown gave you a clearer picture, share it with one person in your life who is asking this same question and not finding a straight answer anywhere else. Subscribe to The Wealth Metrics. Real numbers. No noise. See you in the next one.